Welcome to the Melbourne Property Podcast, hosted by Sky and Lindsay Hammer from Convergence Buyers Agents, your local property experts.
This podcast is your go-to source for insights, trends and tips on navigating the ever-changing Melbourne property market.
Whether you're buying an investment property or your dream home, stay tuned for the next 30 minutes as we give you exclusive insights that will shape your next property purchase. Let's dive in. Hi, I'm Sky and welcome to another episode of the Melbourne Property Podcast. It's a really interesting episode today. We've talked about some really good locations to buy in the last few episodes, but today it's all about the places where you should be avoiding. We get a lot of people either DM us through social media, reach out through the podcast and recommend, what do you think about this location? Or the bad ones, that's what we're going to cover off today. So we're going to run through the data and explain, some of the myths behind some of these investment suburbs, but also talk through them and hopefully make people think twice before jumping into one of these types of investment. But as always, I'm joined by my co-host Lindsay. Lindsay, how are you travelling today?
I'm really well, thanks. How are you going, Sky?
Doing pretty good. Should we kick off with our icebreaker as always?
Let's do it. What are you loving about Melbourne right now?
So to me, it's very much the live music scene. So
that's what I was going to say.
I know why. So for me, I've been to a few gigs recently. And when I say live music, I'm not talking kind of Brunswick local bands, with some of the bigger names that have been in town recently. We had Snoop Dogg recently visit. I did a few kind of shows on the down low. I got to Jelly Roll recently, which I wouldn't say I'm a huge Jelly Roll fan, but I got some free tickets on the day of and actually really enjoyed that show. And then Oasis, which maybe you can talk about that one, but we obviously went to Oasis recently as well. So it's been a lot going on in the music scene. They've got Kendrick Lamar in town in a not too distant future. Yeah,
I think it's definitely one of the benefits of living in a capital city like Melbourne. You've got so many different things on offer, but Melbourne's also known as one of the live music capitals of Australia. So there's, I think, most big name artists always come to Melbourne.
A few starting to get up to Townsville as well.
Interesting. Well, I think Jelly Roll went to Townsville.
There you go. Yeah.
And Shabuzi, was that the supporting act, I think?
Yep. So there you go. They're getting a bit further than the usual Melbourne, Sydney, Brisbane. But anyway, that's enough on the music. But let's jump into our little note from our sponsor. This episode is brought to you by Scale Lending. Whether you're a seasoned investor looking to scale your portfolio or a growing family buying your next home, the team at Scale Lending take the time to understand your strategy and structure your finances for long-term success. With access to over 40 lenders and a deep focus on property investment, they're not just ticking boxes, they're unlocking doors. So if you are ready to take your next step, visit scalelending.com.au, submit an inquiry, and someone from the team will reach out to you.
So in this episode, as Sky mentioned, we are talking about some of Melbourne's worst property traps. So those sorts of suburbs that might look shiny and new, they've got amazing brochures, but when you dig into the data and what's actually happening, they just don't stack up.
Yeah, and we can just call it for what it is. So we're talking about house and land packages in the most part. So not always, but generally we're talking about on the fringes of the city. In this case, obviously Melbourne, but these types of suburbs exist across Australia. They have lots of developers. They have lots of, let's say, buyers agents, but not really flogging off house and land packages.
They're often called property investment consultants.
Yes, or property investment specialists is the other one I see, or buyers agents that just don't charge a fee because legally they're not allowed to, but they're getting paid in the back end by developers $30,000, $40,000 to sell you off one of these products. So
I think that's always a good question to ask though. If someone is trying to sell you one of these products and they say, well, you don't have to pay me, ask them, who pays you then? Where do you make your income? Because that's a red flag. Someone's got to be paying them. They're not working for free. And if it's the developer paying them and you're buying that property, their fee is built into what you're paying.
Yeah, exactly. You're just paying, a premium for a product to pay someone else's lifestyle. So we'll jump into it. Obviously, we're getting a little bit off topic already, but we're going to run through the data, talk through some suburbs. As I said in the intro, there are lots of suburbs that we have people reach out to us. Sometimes I'll get someone reach out, say through Instagram and saying, hey, I just bought this house in Rockbank or Tarneit or wherever it may be. Is this a good investment? And I try not to say, no, that's a horrible decision. I try and talk to, I would have considered X or maybe considered Y. But the main theme I pick up from these messages and speaking to people is the people that fall into this are actually the more risk conservative, individuals or investors, because they're seeing those kind of bright and shiny, as you mentioned, properties. They think new build means low maintenance. So they don't want a 50-year-old property because, it's old, it's going to need maintenance. A few things is, one, properties were made a lot better back then than they are right now. They're not made on the cheap. And two, the ongoing maintenance is such a small cost in terms of a sizable portfolio, even on one property, that it shouldn't be the driving force. It should be a consideration, definitely. But
it's not a strategy. It's not a reason why you buy a particular type of property.
Exactly, yeah. So we'll unpack that a little bit later as well as we work through the data on the usuals, building approvals, supply, demand, all that kind of stuff. So we'll touch on that a little bit as well. So I think there's a few things we can talk through. We can talk through maybe suburb by suburb. I think it works best to work through it today. So maybe if you want to, we'll just kick off with the first suburb and we'll take it from there.
Sure. So our first suburb on the list is Tarneet, located 25 kilometres west of Melbourne CBD. So in terms of the demographics, a lot of these things are going to look good when you start to go through the data. But as we delve deeper, there's going to be red flags that become pretty obvious. So renter to owner ratio, we've got 29% renters. So sits in that sweet spot. Yep. As I said, starting to look all right. The ERSAD score, so that's that socioeconomic score, is 7 out of 10. So that's quite high. Mm-hmm. People living in Tarneet are socially advantaged compared to other suburbs. Crime score is 12 out of 100, so a perfectly good crime score there too. Mm-hmm. What about the typical house prices, Sky?
Yeah, so it's sitting around 756,000 at the moment. So again, it's moved up a little bit over the last 12 months. The rent is around $500 a week. So talking about like a 3.5% rental yield. So again, very consistent for Melbourne. Nothing too scary there. As you said, as you're working through it, and this is what traps a lot of people, you can tell a narrative or sell a narrative quite easily so far based off that information. Right, so I guess taking it a step further though and breaking down both the demand and the supply of the suburb. So days on market, which I mean, if anyone follows us on socials, I love talking about it. It's currently at 54 days. So the markets we've been doing a lot of buying in, Carrum Downs, Frankston and surrounds, we're now at kind of like 11, 12 days on market. So less than 2 weeks to sell a property. Somewhere here like Tarneet, it's currently at 54 days. So we're almost talking 2 months. So instead of 2 weeks, it's taking 2 months to sell a property. So that number alone says, why is a property taking so long to sell? So I guess the first red flag from, I guess, a demand perspective. The next one though, for every property investor out there, the vacancy rate. So it's at 6% now.
Wow.
So if you ever think about it, we're going through a rental crisis across Australia, obviously in Melbourne as well. And if the vacancy rate's at 6%, that's higher than just about anywhere else I reckon I've seen in the country. Clyde North actually may be coming up. I think it's even higher again, but 6% is really high.
So that means 6% of properties in Tarneet are vacant.
Exactly. Yep. They're up for rent right now. It could be more if they're not obviously listed as well. A whole period around 6.1 years. Again, that's much lower than we like. We want to see people holding properties for 8, 10, 13 years, like that kind of longer owner-occupier, family-friendly suburb where they're going to hold property for the long term. That number's been crunched in for a few reasons, particularly in Tarneet. One is that if you invested 5, 10 years ago in Tarneet, you've made money. And we're talking about where were the best places to buy over the last 10 years. Again, there was a lot better options, but the counter narrative I always get, and again, it's people naturally being defensive if they own property there, is I bought in 2017 and now for X and now my property's worth Y. I was like, cool, that's great. We're not talking about that now. We're saying if you're listening to this right now and you're considering investing, this is a suburb I'd be looking to avoid. So the whole periods, what we've seen as well is people cashing out of those investments. Maybe they've learned more about property investment. They know it's not a great place to be buying property. And so they're thinking, actually, you know what? Done okay. It doesn't look like it's going to be great over the next few years. Let's sell up here and move that money into something else. So again, we're seeing, I guess, quite a few sales in that space. I guess supply side. So supply side, and again, if you need to sell the narrative, the stock on market is 0.52%. So again, quite good across Melbourne. Like the sub $1 million market in Melbourne, very hot right now. The $2-3 million suburbs, not very hot. But all across the board, supply is low, other than a few, I guess, handful of suburbs. What's missing is demand, particularly at the higher end of the market, whereas we're not seeing the demand play out here in Tarneet as much. So again, it's just a kind of this market that's kind of sitting there. It's a few percent over the last 12 months in terms of growth. But the other thing, and this is the main reason why we don't like buying here, is the building approvals.
So that future supply. So while the stock on market might be low now, we're also looking into the future.
Exactly. Yep. And so there's two things. Again, I keep saying two. There's actually always lots of different things in play. But with building approvals, it's currently at 4.51%. So there's 1,279 building approvals. So that's 1,279 properties that are about to be built. Obviously, it takes a year or so to happen, but that's incoming supply. Supply is a killer to capital growth. And so you're going to see this market kind of stagnate or potentially go backwards over the next few years unless demand, for whatever reason, absolutely takes off.
Why are people buying in suburbs like Tarneet though? I think it's one of the most popular ones where people come and say, what do you think about Tarneet?
Yeah. And look, there's a few things at play. One is the like developers. There's lots of houses they need to sell out there, so they're putting lots of money into, selling product out that way. So sometimes I make it clear to people that have spoken to like a house land package developer or a property investment consultant, specialist, whatever you want to call them. They're like, oh, have you got a brochure of like, the types of properties you've bought or what we can expect and the infrastructure spending in the region? I was like, have you spoken to a house and land package company before? They're like, oh yeah, we got this other thing. They also were free or $200 as opposed to your fee. So that there's a lot of that happening. So if you're a person that likes a visual and wants to read through all the information, pages and pages, you can get trapped. The second thing as well is obviously is the social media like spending. So there's lots of paid ads selling this type of product, high depreciation benefits. Do you want to reduce your taxable income, all that kind of stuff. There's that narrative out there. But the third,
stamp duty concessions,
new builds. So again, we see a lot of first homeowners buy into these suburbs as well because they want that newer product, or they only have a smaller deposit and they can take advantage of those concessions. Again, all they're doing is distancing themselves, I guess, back further, and that they're kind of building that future supply at the cost of potentially their own, I guess, financial future in terms of investment perspective, which again, people want to live where they want to live. It's a completely different conversation. But the third one, and this one, I don't want to be get too controversial here, but we have lots of clients who are of Indian heritage or Indian by descent. So many of them want to buy in these suburbs when they first speak to us. And it's actually really, it's an interesting thing to watch over time, because a lot of our clients, let's say their family or their parents have bought in somewhere like Tarneit or Truganina and those types of locations. Over the last 10 years, they've seen growth. They've done well. Going to buy property, and so it's just like you pick someone out of Western Sydney, or you can pick someone out of regional Victoria, and like if you just buy where you live, it's not the best like investment. You might luck out, but there's nearly always a better investment suburb. So what's happening is a lot of people are listening to friends and family. Oh, I bought here. You should do the same thing because I made $100,000 over the last 5 years. So
it's anecdotal rather than based on
data. It's not based on data, and it's based on like the people around you. So we've seen a lot of that play out as well. I think that's driving a lot of this. I guess the buyer interest in some of these suburbs as well.
And they are diverse communities in a lot of these suburbs, like Tarneit, Truganina.
Exactly. Yeah. Yep. Lots of demographic, bit of immigration into some of these suburbs we're going to talk about as well. And again, whether it's an Australian dream, buying a brand new home, all that kind of stuff, some of that plays into it as well. But it's definitely something we're seeing. Is it's not like, again, we're saying it's not anecdotal, but for us it's mostly anecdotal. But we've seen enough of it, particularly through socials and other means, that it definitely seems to be a bit of a trend.
All right, we might move on to suburb number 2. We've already mentioned it a few times, Truganina. So staying out west, we're now going just 8 kilometres down the road. So it is 22 kilometres west of Melbourne CBD. Mm-hmm. The demographics, again, we're still looking pretty good if this is sort of the only data that you're looking at. 31% renters, 7 out of 10 for that URSAD score, and 12 out of 100. So almost identical to Tarneit in terms of those general demographics.
Yep, exactly. Yeah, and so again, it's one of those ones that ticks those boxes. If you need to sell the narrative to why to buy there, it is achievable. Typical house price now around $800,000. So again, that's getting quite up there. Rent's still around that 500-ish per week. And again, we can touch on why that's the case. The yield's around 3.25%. So it's starting to get pretty low, even for Melbourne standards. Days on market, 45 days. So slightly better than Tarneit, but again, it's still up there. And we're going through this housing crisis, for something kind of sitting there for that long is far from ideal.
Particularly in the sub $1 million price point.
Exactly,
everything else in that price point is flying. Days on market is extremely low.
Yeah, yep, exactly.
A lot of demand.
Yeah. The whole period still around 6.56 years. So again, they're not holding long term. They're kind of, and it is a relatively newer suburb, but again, that whole period's just not where we'd like to see it. So again, it's very similar. Stock on market, 0.44%. Sounds great. However, building approvals, 4.47%. So another 889 properties coming their way in the not too distant future.
I guess if you had to choose between the two, though, the data does look slightly better for Truganina.
Yeah, potentially. Again, we're not investing in either of those. Having said that, there are lots of buyers agents buying in these suburbs. And we should mention that I blame house land packages and developers, all that kind of stuff all the time. There's actually plenty of buyers agents buying these suburbs too, whether that's because they live there and they're buying there. I spoke to a potential client this week and they came to me because they'd spoken to another buyer's agent. Sorry, they've actually signed up with another buyer's agent, but they're now recommending buying there. So that was a kind of red flag. I think it was a socials post or something that they've heard, or maybe it was a podcast, but that's actually made them pivot back and be like, actually, why is he recommending out that way? So again, it's not just mum and dad investors. There are buyers agents actively buying in these suburbs as well.
Okay, moving on to suburb number 3. We're going to be talking about Rockbank. So still out west. We're now 29 kilometres west of Melbourne CBD. Very similar again on a lot of these demographics. So 31% for the renter to owner ratio, 5 out of 10 for that URSAD score, but 25 out of 100 for the crime score. So that's actually the highest on this list, and that's tied with Melton South that has the same crime score, and we'll be talking about that one later.
Yeah, and this one we're dropping down in price now. So that typical house price is around $653,000, rent around $475 a week. So the yield's actually higher than the others at 3.78%. So it is that little bit higher. Days on market, sitting around 53. So again, we're getting close to that kind of 2 months to sell a property type window, and the vacancy rate at 7.81%. So
that's the highest on this list.
Yeah. It's basically 1 in every 10 properties in the suburb is up for rent at the moment, which is obviously scary. And again, I'm going to go off topic a bit in some of these as I get kind of jots my memory on a few things we've seen or heard from other people. But I did have actually someone reach out to us. They bought a property in Rockbank 3 or 4 years ago. They hate living there. It's
owner-occupied?
It's an owner-occupied property. They bought it because of, obviously cheaper deposit or whatever it was to get into the property. They want to get out of there, but what they paid for it, they won't get that back if they sell it right now. So it's one of those kind of annoying and unfortunate stories where you hear they want to get out of what they've done. They realise they don't want to live here because there's no infrastructure. It's not a great place to live. It's kind of stuck between Melton and Melbourne. It's kind of in this kind of bit of a dead spot. I actually just did a socials post on Rockbank recently this week as well because one of the heat mapping tools that we use when we're looking at data, can't show it. If you listen to the podcast, you can't see it. If you're watching it, I might try and bring it up. But what we do is we map out days on market, vacancy rate, stock on market, all that type of stuff. Green means good, red means bad. And once you hit this kind of pocket here, when you hit like Rockbank, Aintree, before you move into Melton, and Truganina and Tarnita in this dark red kind of dead west area of Melbourne as well, it goes from green and goes to orange and just goes red. And you can basically almost you know straight away that these are suburbs to avoid just because it's so stark. The difference between these kind of low supply kind of markets that are hot with both homeowners and investors right now versus these ones where people are being paid to sell these properties. They're not just agents, but other people to sell them just because the stock's sitting there. So it's an unfortunate story, and it's not unheard of. I've heard this from a few other people as well where they've bought and they don't like living there. So now it's, do I sell or do I hold it as investment and then potentially go rent somewhere until the market picks up in these suburbs and they can get their money back? So again, this is not just pure investment, but even for people that are looking to maybe move out that way, just something to keep in mind as well, because it can lock you in terms of your freedom in terms of where you want to move to next.
And speaking about whether you sell or hold periods for Rockbank are 4.78 years, which is absolutely the lowest on this list and probably the lowest I've ever seen.
Yeah. And it is a relatively newer suburb, which would explain some of it. But again, it's not what you want to see in the data. But again, let's strap in for another, going off tangent. But it's another thing that we see a lot is that from the conservative investors that are buying into these places. So we've spoken about fancy brochures, makes them look investment grade properties. The other bit that we hear a lot of what traps people into this is that they're offered like 1-2 year rental guarantees. And so they're basically saying once the property is built, we're happy to pay the rent for the next 1 to 2 years. It's guaranteed rent, let's call it 4%, 5% rental yield. And to a conservative investor, they think this is completely free. Like my downside risk is minimized. I don't have to have the property vacant for 1 or 2 months or longer, whatever it may be. I can't lose here. I'm getting a brand new house, low maintenance. That's great. But there's a few things to unpack with that. One is that if they have to guarantee you can get tenants just to get you to buy the property, huge red flag. Number 2, that's baked into the purchase price. So the developers are they know that it's probably not going to get rented out. The vacancy rate being at 7.81%, you're not going to rent that out. They've baked that into the purchase price. So they've probably added a premium on saying rental guarantee, $30,000 a year. So they've already put that into the purchase price as well. So they're not at a loss. And what's happens, and we see it time and time again, is that you get through, let's call it, buy the property, settles, you have the 1 year rental guarantee, get to the end of that 1 year, and then guess what? Your neighbour, the other 10 properties on the street, which are all built at the same time, all come off that rental guarantee at the same time. They're all up for rent at the same time, and that vacancy rate just continues to tick up. And then that's when you get into trouble. But also your house has probably gone backwards as well, so you're in negative equity. So really kind of horrible trap that I think it's actually the conservative investors are actually falling for more than anyone else.
If we have a look at the supply side for Rockbank as well, so supply, when just at face value, looks all right. So it's 0.61%. Inventory levels at 1.38 months. Building approvals aren't too bad though, particularly when, we are looking at the list of the worst suburbs to buy in. So it's at 2.56%.
Yeah, so 89 approvals, which again speaks to it is a smaller kind of newer suburb if you look at the numbers compared to the other ones. But again, 89 new properties in a suburb, you're not seeing that in most other locations in Melbourne. So just something to factor in. All right, suburb 4. We're going to switch roles. Maybe I'll run through the first part of it for this one. We're 42 k's north of the CBD. Again, I've looked at this suburb in depth because I've had a lot of people request it. Interestingly, I think it's called North Beveridge. So we're going to touch on Beveridge now, but the state government's actually formalised and announced a brand new suburb of tens of thousands of more properties to be built out this way over the next 10 years. So again, a lot more supply coming out that way. Again, I don't think it's going to come with the required infrastructure. So again, we're just blocking up roads, fewer amenities for more people. But again, that's a little side note. So let's jump into Beveridge. That renter-owner ratio around 17% renters. So again, that's completely fine. OSAD score at 7, which again, no issues with. And that crime score at 21. So beginning to creep up a little bit, but again, not too bad there.
And if we take a look at the typical house price, that's sitting at $680,000. So you can see why that is sort of a sweet spot for many investors around that price point. It has grown a tiny bit in the past 12 months, so it's grown about 2%. Affordability index is at 27 years to own, so that's a tick. The yield is a little lower though. It's at 3.55%. So on par with a lot of locations in Melbourne, but when we're purchasing around that typical house price of $680,000, we prefer and we can buy in other markets closer to 4% or above.
Yeah, exactly. Days on market sitting around 42. So again, over a month, but not too bad. We're starting to see the numbers come down, which is good. I'm not sure if this is in order, this list of best to worst or worst to best, but we'll wait and see. Vacancy rate at 7.41%. So again, it's the second highest on the list. And again, it's up there and you're basically not going to rent your property out. And the whole period around 5 years, which is pretty common for a kind of a newer suburb like this one. Supply, again, stock on market, 0.49%, which is what no issues with, but building approvals, and this is what we're talking about. So one thing you can't see listening to this podcast, and if you don't already, go check us out on socials because I do a lot of these posts on these suburbs more as an education piece, like a lot of do not buy in this suburb, or to actually say what it's called, like top 10 shittest places to invest in Melbourne is a lot of the content I put out. The building approvals. So here it's at 10.88%. So there's 522 new dwellings coming into a pretty small suburb, which again is the highest on the list. But if you go to Google Maps and look at any of these suburbs we're going to work through today, go to satellite images and you can see the development that's happening. So you'll see dirt roads, you'll see sand being laid, you'll see construction, diggers, all kinds of stuff. And you can see it's not just maybe the inner ring of that suburb, it's just spreading out. So you'll see that sprawl and all that future supply coming. What you won't see is any kind of new main roads being built to accommodate that. You generally don't see new schools or anything else being built with it as well. So just keep that in mind because you can, without having to be, if you're not a data person, this is another way to check this stuff. And let's go on satellite view, Google Maps, and see what's happening. Obviously, we use a lot of other platforms other than just Google Maps, but it's a nice little exercise for anyone that does want to check it out themselves.
And even if you can't see them building the new developments, you can see the vacant land.
Yeah.
And sometimes vacant land is okay. It depends on the zoning and what's there. But that's always a question. If you see a lot of vacant land around a suburb that you're looking at, question what can that land be used for, what's likely to be in the future.
Yeah, yep. And some people get caught out, especially interstate investors, like trying to buy interstate, that you can see land and think, okay, don't buy here. So we don't want to go the full extreme. There are some examples of where the land kind of, it's not developable. Could be a form of quarry, could be like a floodplain. Like I know a lot of people in towns will, when they're looking there, said, oh, you can't, like, look how much vacant land there is. I was like, well, put the flood mapping overlay on and see that is a river, essentially, that is currently not occupied. So, again, there's a lot more due diligence, as you've said, to do to get to know where to buy and what to buy.
Suburb number 5, another one that you talk about quite a lot, Sky.
Yes, one of my favourites, Clyde North. So we're 54 k's southeast of Melbourne, and Lindsay's laughing because I have had a post go viral. I think it's had 500,000 views or something like that these days, just to get people messaging me about it. But basically just talking about why this is not a good place to buy. And again, it's consistent with the narrative we've had so far. But I just like to say Clyde North because for whatever reason, it's the one that gets the most marketing attention. It's the one we hear about the most from people. So just to keep in mind that it's probably not a suburb to invest in. Obviously, all the disclaimers that this is not financial advice, but maybe have a look at the data before you jump into a place like Clyde North. But again, the initial stuff, renter-owner ratio, 24% renters, nothing bad at all there. URSAD score, 8 out of 10, completely fine. Crime score, again, at 14. So that kind of consistent narrative there, that's fine. Typical house price, though, 881,000. So now we're getting up there on price. We're in a location that has, I would say, some of the worst infrastructure spent in the area. It's grown a lot. But you can't Google Clyde North, you can't search it on socials without coming across examples of how bad the infrastructure is, whether it's blocked roads, just like internet doesn't work, like it's heaps of that stuff going on. And this is affecting more homeowners than it is investors, but just something to keep in mind as well, which you won't see, I guess, just looking at the data. The rent yield as well, around 3.2. So because those house prices are getting up there, particularly as construction costs rise, we're seeing that the cost of building those properties is going up. So the other narrative that we hear a lot is that, well, I paid $650 for mine 3 years ago, and now it's worth $850. I was like, no, the developers are selling them off at $850, but on the open market, you're probably not going to actually sell it for that much. We get a lot. Like we're buying a lot in Cranbourne. That's no surprise. But again, we only buy in certain suburbs of Cranbourne. But every Cranbourne agent is selling stock in Clyde North. I get a lot of properties a week in Clyde North off market, and they don't sell. And I'm sure I'm not the only buyer's agent getting access to those, but lo and behold, in a few weeks, they pop up online because no one wants to touch them. And they sit there for longer. I don't say it's like a deal, but like I feel like sometimes people are like, some of the agents are like, I haven't got the one for in Cranbourne, but like if you buy this one in Clyde North, then I'll give you the one in Cranbourne next. Like it's not that black and white, but you can just see they want help selling off this Clyde stock. So
that's a good segue into demand. The days on market is 51 days
exactly
for Clyde North.
Yep. So it's sitting up there. It's more established than some of these other suburbs that are kind of even newer. But yeah, that days on market's really high. Vacancy rate's at 5%, and that whole period's still around 5.5 years, which is obviously pretty low.
I think another thing we haven't touched on yet with a lot of these newer estates are the land sizes. So generally you're getting a lot smaller land size. So you might be getting a 4-bedroom new build house, but it's on a smaller land size. And as everyone listening to this podcast probably already knows, it's the land that appreciates and the house that depreciates. So you're really focusing on buying a depreciating asset in those instances. Yeah,
exactly. Yeah, and we have a lot of people come to us who say, like they know what we're about and we're buying established houses, but they still want the look of a house and land package, but for the price of a, I guess, older established house, and they want twice as much land. So it is hard to do both, particularly in that sub 950 price point. But yeah, I think it's it's pretty consistent, as you said. We're seeing that in these developing kind of suburbs or newer suburbs that the land size is around, call it 300. Down as low as 200 we're seeing some, and they're still considered houses, not townhouses. So yeah, something to keep an eye on. And a quick tip for anyone, if you're on realestate.com and domain and the house is a freestanding house but the land size isn't listed, I can almost guarantee it's going to be under 350. That's kind of why it's hidden from the main view.
Yeah, we often get people, like particularly clients, when we've presented a property and they say, but what about this one? And it might look newer. And they say, why is this one cheaper and it's a better house? You're like, yes, because look at the land size. And yeah, it's often not listed, but we have access, obviously, to data and platforms that will tell us what that land size is. Yeah. It's often half the land size of the ones that we're recommending. Yeah.
Again, stock on market, 4.8%, pretty consistent for most of these suburbs. But the building approvals is 8.47%. So 1,675 properties still to come. It's not the highest on the list.
Not the highest percentage, but it is the highest number of approvals. Yeah. So compared to the suburb size, not the highest, but the highest number.
Exactly, yeah. And if you go again and look on Google Maps, you'll just see how big the suburb is and just how much more it can expand. So it's no surprise to see those approval numbers.
Shall we move on to suburb number 6?
Sounds good. Our friends in Wollert. So we're 26 k's north of the CBD. Again, don't want to repeat it, but the initial numbers look fine. URSAD score of 6 out of 10. Percentage of renters at 24, which is in that sweet spot. And the crime score of 10 out of 100,000 in terms of how they capture that. Typical house price now at $820,000, but they yield again around 3.32%. So it's interesting as well because at that price point, you can definitely do better in yield. You can obviously do better in capital growth. But as these house prices do tick up a little bit, the thing that's really killing the yield is at the vacancy rate, and there's so many available for rent that you're just not getting any rental growth. It's just kind of flatlining or going backwards. So I think that yield's going to get even closer to 3 by the end of this year and into early next year.
And on the demand side, days on market sitting at 37 days. Vacancy rate is high, but not the highest on this list. It's at 4.78%. The hold period is pretty similar to a lot of these other suburbs. So for Wollert, it's 5.24 years.
And Wollert's another one we've had examples. Again, this is anecdotal, but people that have bought out there, they wanted to live there. They've got to commute into the city. And again, that kind of northern corridor trying to get through there with traffic as they build out more and more suburbs out that way. It's just getting worse by the day. And again, we had someone who wanted to potentially sell, but they weren't going to come out in front. So do we hold? Do we rent close to Melbourne? And that kind of narrative is becoming more and more common by the day. Funnily enough, and I don't want to get in trouble off of this one now, but we had I guess a very famous person follow some of our stuff recently online. Let's call her the Premier of the state. And it's interesting that they're pushing these kind of house loan packages still because in the Victorian government's eyes, and this is at a national level as well, you've got to build supply somehow. And the only way to build supply is to build new houses. And that's what's happening. But it's first homeowners that narrative is being kind of warped to do. So there's obviously the investors that we talk about that go and buy this stuff. But they also push it on to first homeowners to be the ones that have to go and buy out in these regions. So it's the incentives, whether it's a deposit, the other incentives you have as a first homeowner, they always have to be in these suburbs. So that's why we hear these kind of, I guess, unfortunate narratives of bought there, got into the market, but then it's actually setting me backwards. Which is why I hate it when it happens. We've got a family, we've got young kids. We're still happy to rent. And I think there's still this thought process around, I need a house to live in. Either it could be just one person or it could be a family with young kids. They need that security as well. So it's just something that people have. And then they get out there, they're long-term or whether they're a short-term and realize they don't want to live there, but they get trapped. I haven't got a name for it. Like, it's not like a mortgage trap. I'll have to think of a term for it.
It's like the equivalent of debt trap diplomacy, but in the property.
Yeah, it is, right? Yeah, you get sold this amazing lifestyle and then you get there and you can't. And then financially, it's very difficult to get out of it. So long-winded and slightly not too aggressive attack on maybe the government, but it's just one of those things that it's a pain because we see it all the time. And there's nothing we can do about it because it's already happened. But it is annoying to see that, and it's going to keep repeating because this 5% deposit scheme, heaps of people are going to go out and buy in these suburbs because they want to own their own house. But it's more of a passion project now. I'll move on. But
we'll move on to suburb number 7.
Yeah, yep.
So now we're going to be talking about Wallan, located 45 kilometres north of the CBD. So still talking in those northern suburbs. Similar demographics, 21% renters, 5 out of 10 for the URSAD score. Crime score is a little higher at 20 out of 100. Typical house price, though, is $605,000, so quite affordable, and that's what's sort of driving, I guess, some investors to be buying there. It's actually gone backwards, though. I think it's the only one on this list that has gone backwards over the last 12 months. It's gone only a small amount, 1.35% decrease in house prices.
Yeah, and that's the other thing to mention. There's the other ones that have ticked along. So again, the sub 850 in Melbourne, most of those markets have grown. So let's say there is money to be made, but I think the bigger thing to point with these suburbs is there's a lot of money to be left on the table by buying here as opposed to somewhere else in Melbourne or to be in. There are
better locations to be chasing capital growth.
Yep.
The yield for Wallan is sitting at 3.95%.
Yep. Yes, that's getting up close to the higher in the list there. So around that 4%. Affordability price, despite going backwards, the rents, there's that kind of floor in Melbourne. If you want a 3-bedroom house, you're paying $480, $500-ish. You can't really get one cheaper than that. That's kind of why that yield stacks up okay still. Days on market at 52. So again, we're in that kind of in the 50s where we don't really want to be. Vacancy rate at 5.31%. On the supply side, stock on market at 0.64 and the building approvals at 1.38%, so slightly lower. But again, 100 new properties coming to that suburb over the, short to medium term.
Shall we move on to our last suburb on this list?
We should, and it's our friends over in Melton South. So 35 k's west of the CBD. Again, Melton West, like Melton South. We actually don't get asked about Melton South as much. But people are buying Melton West a lot. So Pretty good renter-owner ratio still. The URSAD score is 1 out of 10. So it's the lowest on the list, and this speaks to, I guess, Melton as a whole. And the crime score is 25, which is also the highest on the list, kind of tied with Rockbank. But just again, we've got a place now where we're the bottom of the low socioeconomic ladder, which is also combined with the high crime score. I don't know if they correlate perfectly, but I mean, it's not a huge surprise to see that. Typical house price in Melton South, though, is at $587,000. So it's the cheapest on the list. It's up there with the cheapest across metropolitan Melbourne as well, to be honest. Interestingly, though, and this is why it's going to be one that burns quite a few people, it's actually grown 10.57% over the last 12 months. And so I get this.
Great growth.
It is. And I get this thrown back at me all the time being like, I bought this property in 2023 or 2024 for $450,000. It is now worth $520,000, made $70,000. You don't know what you're talking about. I was like, okay, good. Property investing is not a game of 6 to 8 months. It's obviously a lot longer play than that. But we're seeing this in Melton South. But again, Melton South is that kind of house and land package, which is why it's on the list, because it's 300 square metre blocks, new builds, houses touching each other, roofs basically connected together. Whereas Melton West and Melton, like old
more
Melton,
established houses there.
More established. So like we're not buying property out that way, but we do know people that have. And like lots of buyers agents, lots of interstate investors been buying up that way because it's cheap, the yields are good. And they're like, oh, it's 35, 40K to the Melbourne CBD. You can't sell that cheap forever. So just something to keep in mind. Some money to be made, but definitely not a market we'd be buying into for our clients. Days on market sitting at 30. So again, we're at this lower price point here. There is the demand of the market, particularly from interstate buyers. Vacancy rate though, 6.4%.
And that's the killer right there.
Yeah, yep. And so we have this narrative, and I guess there's a few things that'll feed into this. And again, sorry for everyone listening, it's another tangent, but it's a useful one. I don't know for a fact that this is building into this vacancy rate, but I do know from fact from speaking to people who've been burnt and through messages and actually speaking to developers out that way, it is a place that if you don't have a really good landlord insurance and tenant, I guess, protection, you're going to lose a lot of money, and you're going to lose a lot of money very quickly. So one piece of that is the vacancy rate, having huge hold periods. But the second one, and the more frustrating one, and I guess the bigger issue when you're buying in the kind of communist state of Victoria, is that it's very hard to get tenants out. And so I actually spoke to a guy recently who bought 3 properties in Melton over the last 18 months. Thought he was doing a great idea, made some equity, had no issues with that. All 3 of those properties right now are in front of VCAT. So for those...
All three.
So for those that don't know, VCAT, the Victorian Civil Administration Tribunal, is basically if there's a dispute between rental provider and renter, no longer landlord and tenant, that's where it goes. And so all 3 have stopped paying rent, and all 3 have done, I guess, to varying degrees, damage to the property when they've been in there, and they have no plans of moving out of the property, fixing that up. And so in 2 examples, this the guy doesn't think he's actually going to be able to get them out. He may get them to start paying rent. But again, like this happens across Melbourne, and like happens in some of the suburbs we're buying in out near Frankston and surrounds. But to this degree, it's the only location I know in, I'd say, Victoria. Again, this is not based on data, but just it sounds so common. And we have a lot of people buy there, or people that maybe don't use our services. They come to us and say, I've got $550 to spend. I want to buy a house in Melton. I said, we're probably not the buyer's agency for you, because that's not where we're buying. We don't want to buy there for our clients, because we also don't want to be the ones that in 12 months' time, when you've got a tenant that's trashed your house, not paying rent, we don't want that of experience that some of our clients go through. So you might make 50, even 100 grand, I reckon, over the next 12 months buying out there. But the headaches that are going to come with that is just not something personally I'm interested in for our clients.
A few other things to say in response to that too is buying 3 properties in the same suburb, probably also not what we'd necessarily recommend. Like that diversification is great because you're not having all your eggs in one basket. Also making sure you have a really good property manager on your side, because you want to make sure you get great tenants, and then that property manager is going to be working for you in your best interest and really servicing your property to make sure they're paying rent on time, repairs are all done, that you're not falling into those sorts of traps.
And honestly, it's a trap a lot of people are going to fall into as well, particularly because of the high vacancy rate, is that if you've only got 1 or 2 applicants, you're going to take 1 or 2 of those. Again, you're going to take 1 of those applicants, or you can maybe have a few more inspections, but it comes to a point where you're going to take the risk on one of them because there's just not many applications coming in.
Yeah. And I think the other one is having really good landlord insurance in place. Yeah. And I know some people don't even go down that path because the premiums sometimes are quite high, and they say it doesn't make sense, but it is important to have good landlord insurance in place.
And I think maybe $500 or $600 a year, which for most of these suburbs is 1 week's rent. If these tenants stop paying this, every insurance provider is different, obviously, but generally speaking, if you get it and your tenant stops paying rent for a month, then it kicks in. So again, you're getting your $500-$600 back within a month.
Obviously,
or so.
this is all generalised. It's not advice. Speak to your insurance broker.
Yeah, exactly. Yeah.
Just quickly on the supply side, it's sitting again, looks good, so 0.44%. But the building approvals are a little bit higher. They're at 3.14%. So typically, we like to see that number under 1%. So anything over 1%, especially if it's creeping up, that's when we sort of look at that future supply as a no-go.
Well, I think it's all the suburbs. I think we got through them. Yeah.
Do you have any final remarks, Sky, on house and land packages or the government?
Obviously do your own research. But yeah, house and land packages, if you're a rent vested today, if you're 25, you want to buy your first home, I would strongly consider rent vesting. I didn't do that. I also didn't buy a house and land package. But if you're like the boomers, they're lazy, they had it easy, they made a lot of money just buying their house for $89,000 and it's now worth $3-4 million. But they didn't take advantage of that. So I had this conversation with someone recently that I think this generation are actually going to do far better in property because of the education piece. They know what to do. They know how to release equity. There's so much free content out there. So they actually don't have excuses. The hardest bit is getting into the market. And so for us, for this generation, it's not buying where you want to live, it's buying the best investment. So if you can only afford $600,000 right now and you don't want to live in one of these suburbs, go and buy in Queensland. Go and buy in Region Victoria. Go and buy in Tasmania. There's so many better options from an investment perspective, which allows you to get into one property, potentially 2, 3, 4, whatever is down the track. And then what our plans are in the future, when you know where you want to settle, sell off some of those properties. You almost have a debt-free, PPOR at that stage if you wanted to. So that would be my words of wisdom. If you're looking down this path, potentially look at other options that are out there, even if you're on a reduced budget. I think you can do quite well. And secondly, so apologies for the waffling nature of this episode. I try to mix it up just because obviously the data is quite similar for some of these suburbs, and I always like to throw in some anecdotes on what we're seeing on the ground here as well.
Very good. Very insightful. Thanks so much, Sky.
Perfect. That's a wrap for this episode of the Melbourne Property Podcast. Just a reminder that this information is general in nature and should not be considered financial advice. If you'd like to discuss your personal situation, book a discovery call with the team at Convergence Buyers Agents. Our link is in the show notes.
If you learned something from this podcast, hit subscribe and never miss your fortnightly dose of Melbourne property insights. Catch you next time, and happy house hunting.